Welcome to this deep dive. Let's actually start with a quick thought experiment.
Okay, I like thought experiments.
Right. So imagine owning 28 massive steel apartment buildings.
Oh, wow. Okay,
Oh,
that's a lot of real estate.
yeah, exactly. Now imagine paying off the mortgage on all of them, like entirely in just 3 years.
That's basically unheard of.
Right. And you're also sitting on a mountain of cash. But here's the catch. You're doing all of this while your properties are actively dodging literal missiles in the Red Sea and, navigating the fallout of a billion-dollar global trade war.
It's a staggering contradiction, really.
Yeah.
Because we all rely entirely on the physical movement of raw materials for almost everything in our lives.
Oh, absolutely.
Like from the plastic casing on the device you're holding right now to the gas keeping your home warm in the winter. Yet the company is actually moving those materials across the oceans. They're currently operating in what feels like a geopolitical minefield.
Which brings us to the core of what we are unpacking today. We're looking at the Q4 and full year 2025 financial results presentation, along with the 2026 Form 20F SEC filing for a maritime shipping company.
Right, StealthGas Inc.
Exactly, StealthGas. They specialize in transporting liquefied petroleum gas, or LPG, around the world. So, okay, let's unpack this. Because the financial numbers they are posting, given the state of the world they physically operate in, require some serious explanation.
Yeah, the contrast is definitely sharp. When you look at their 2025 financial highlights, StealthGas posted a net income of $60.6 million.
Wait, 60.6 million?
Yeah, which translates to an earnings per share of $1.64.
Oh.
And their total revenues, they hit $173.2 million.
Okay, those are big numbers.
They are, but the figure that fundamentally alters their risk profile, like the one that really jumps out of these SEC filings, is their aggressive debt reduction.
Yeah, I saw that. Over the last 3 years, they wiped out roughly $350 million in debt, right?
Exactly. In 2025 alone, they paid off $85.9 million.
That's just wild. So today, all 28 of their fully owned vessels are 100% unencumbered.
Free and clear.
Meaning they literally own these massive ships outright. Plus, they're sitting on $99.1 million in cash. But to really understand why this is such a huge deal, we need to talk about how shipping companies usually operate. Because owning 28 massive ships outright is not the industry norm at all, is it?
Oh, far from it. No, the maritime shipping industry is incredibly capital intensive.
Yeah.
Building a single commercial vessel costs tens of millions of dollars.
Just for one.
Just one.
Yeah.
On top of that, these ships are depreciating assets. They require constant, incredibly expensive maintenance.
Like the dry docking, right?
Exactly. Mandatory dry docking every few years where the ship is literally lifted out of the water.
Oh.
So because of those massive capital requirements, debt is basically the lifeblood of shipping.
So companies are usually just drowning in debt.
Yeah, they're highly leveraged. They're constantly taking on new massive loans to finance the next vessel and just, relying on future charters to pay the interest.
And the freight market itself is notoriously cyclical. Like 1 month, the demand to move gas is sky high and you're charging a premium.
Right.
And then the next month, the rates crater. If you have a massive loan payment due and the market dips, you go bankrupt. So how did StealthGas manage to completely deleverage their balance sheet without getting wiped out by those inevitable market dips?
Well, the mechanism they use is a reliance on what the industry calls fixed revenues, specifically through time charters.
Okay, time charters, how does that work?
So rather than just throwing their ships into the open market, which is called the spot market, and hoping rates stay high, they lock their vessels into long-term contracts.
Oh, I see.
Yeah, the filings show that 48% of their fleet days for the remainder of 2026 are already locked into these fixed time charters.
Wow, almost half.
Right, and that secures over $104 million in guaranteed contracted revenue.
Wait, so they are willingly leaving money on the table then? Because, if spot market rates are going through the roof because of all the global chaos we're seeing, ships getting blown up, routes getting longer, locking into a fixed contract means they miss out on those massive, unpredictable windfalls, right?
That is the exact trade-off. It's a choice between maximizing potential yield in a really volatile spot market and ensuring absolute baseline survival.
Okay, that makes sense.
Because in the spot market, the ship owner usually pays for the fuel, and you eat the cost of any delays. Like, if your ship is stuck waiting at a port for 2 weeks, you are bleeding money.
Yeah, you're paying the crew, the maintenance, everything.
Exactly. But in a time charter, you are essentially leasing the ship and the crew out at a guaranteed daily rate. The charterer absorbs a lot of that operational volatility.
Ah, so it is a strategy of extreme financial conservatism.
Precisely. They know exactly how much cash is coming in, which allows them to uh, systematically pay down that debt without the existential dread of a sudden market crash.
Okay, so they essentially built a financial shield. But, I mean, a bulletproof balance sheet doesn't actually protect a physical ship from actual bullets and bombs.
No, it definitely doesn't.
Because the 20-year F details some incredibly stark operational realities. This isn't just about managing interest rates, it's about navigating physical war zones.
Yeah, the geopolitical footprint of their operations is complex, to say the least. The SEC filing objectively lays out the real-world obstacles their fleet is encountering right now.
Let's look at the Eco Wizard, for example. According to the documents, this vessel was damaged by an explosion in a Russian port in July of 2025,
Right.
and it is currently totally out of action, just sitting in Riga, Latvia, undergoing assessments for the damages.
Yeah, a massive disruption.
And then there's the Eco Oracle. That ship is currently trapped in the Persian Gulf. Because of the war between Iran, the US, and Israel, and the effective closure of the Strait of Hormuz, this ship literally cannot leave.
It's completely stuck.
Right. And on top of all that, the filings mention the ongoing threat of Houthi attacks for any vessel transiting the Red Sea in the Gulf of Aden. I mean, you cannot run a reliable logistics network when your multi-million-dollar assets are getting blown up or blockaded. How are they physically functioning?
Well, largely by utilizing geographic diversification and highly specialized insurance structures.
Okay, break that down for me.
So, while having a ship trapped or damaged is a huge operational hurdle, StealthGas is not overly concentrated in one single high-risk corridor.
Oh, I see.
Yeah. The filings note that 70% of their fleet trades west of Suez.
West of Suez, meaning?
That means the vast majority of their operations are occurring in Europe, the Mediterranean, and the Black Sea.
Okay, so they spread out the board. If one region is locked down, the rest of the fleet is still moving.
Exactly. And furthermore, these vessels don't just carry standard property insurance, they carry comprehensive coverage that includes specific war risk indemnification.
Wow, war risk insurance. That sounds expensive.
It is, but it's necessary. For instance, with the Eco Wizard, the company anticipates being indemnified for the loss in accordance with its insured value.
Yeah.
So the insurance acts as a financial backstop against physical destruction.
But for the ships that are still functional, merely avoiding these conflict zones changes the entire equation, right? If you can't go through the Red Sea, you have to sail all the way around the continent of Africa.
Which fundamentally disrupts the mechanics of the entire supply chain. A longer route takes more time, which shrinks the effective supply of ships available to move goods.
Right, because they're tied up at sea.
Exactly. And more importantly, those longer voyages burn significantly more fuel. In maritime terms, that spikes the bunker costs.
Bunker costs. Got it.
And if you do choose to operate anywhere near these zones, your war risk insurance premiums just skyrocket.
It's like this compounding domino effect. The longer the route, the more fuel you burn, the higher the insurance, and ultimately, all those extra millions of dollars get passed down the line to the end consumer.
Yeah, someone has to pay for it.
But, you know, a ship doesn't have to be hit by a missile to be knocked out of a market. Sometimes a piece of paper in Washington or Beijing can be just as devastating. Let's talk about the massive economic warfare happening right now.
Oh, yeah. The tariff tug-of-war is reshaping the global map just as violently as the physical conflicts, albeit in a more, bureaucratic way.
Definitely. I'm looking at the trade disruptions between the U.S. and China detailed here. In April 2025, the U.S. imposed a blanket 10% tariff, plus targeted tariffs of over 100% on China.
Right, massive tariffs.
But the part that directly impacts the logistics we are discussing today are the port fees. The U.S. announced massive fees specifically targeting Chinese-owned ships, starting at $50 per net ton and scaling up to $140 per net ton over time.
Which is huge.
Yeah. They even hit operators of Chinese-built vessels with fees up to $33 per ton.
And of course, China immediately retaliated with massive fees of their own on U.S.-built or U.S.-owned ships, ranging from 400 to 1,120 Chinese yuan per net ton. Yeah. And while both sides temporarily paused these specific port fees in October 2025, the sheer scale of the threat injected profound uncertainty into the maritime market.
I mean, I'm looking at these port fees up to $140 a ton just to park your ship. You can't just absorb a cost like that, and you can't just stop delivering essential gases. So who actually pays for this economic standoff at the end of the day?
Well, the companies caught directly in the crossfire suffer immediate margin collapse, obviously.
Hmm.
But ultimately, those friction costs are passed to the global consumer.
As always.
Right. However, this is where we see the unique insulation of StealthGas's specific fleet. According to the data, they completely sidestepped the heaviest blows of this specific tariff war.
Oh, really? How?
Because of their fleet origins. Absolutely neither of their vessels were built in China.
Oh.
Yeah, their entire fleet was constructed in shipyards in Japan and Korea.
Okay, so when the U.S. says we're slapping a fee on Chinese-built ships, StealthGas just sails right past the toll booth. But how does global trade actually keep flowing when the two biggest economies start throwing up these massive walls? Like, the gas still has to move.
Right, it's like water in a pressurized pipe system.
Hmm.
If the U.S. and China pinch off one massive valve across the Pacific with these tariffs, the water, or in this case, the global demand for LPG, doesn't just disappear.
It has to go somewhere.
Exactly. The pressure simply forces it through a longer, more complicated network of pipes. The filings point out that as China diversified its LPG sources to avoid U.S. tariffs, the U.S. share of LPG going into China dropped from 60% down to just 30%.
Half of the U.S. market share into China just vanished overnight. So where did the gas come from instead?
Canada and the Middle East stepped in to fill the void. The overall global volume of LPG being transported actually saw steady growth, up 6% in 2025.
Wow.
But here's the crucial mechanism. It's what they call ton miles. When China replaces U.S. gas with gas from the Middle East, the physical ships are drawing new, often longer lines across the map.
Which brings us right back to the physical math. Shifting trade routes across the globe doesn't just cost more money, it takes more time.
Right.
If ships are spending 20 extra days at sea to navigate around tariffs or war zones, they are tied up longer. That means you need more ships in the water just to maintain the exact same volume of daily deliveries.
Yes, exactly.
Are there even enough ships in the market to handle that?
Well, that is actually the most critical structural element of the StealthGas strategy. You have to look at the physical supply of the vessels. StealthGas focuses heavily on what the industry calls small LPG ships.
Okay, small ships. What does small mean in this context?
It means vessels with a capacity between 3,000 and 11,000 cubic meters, along with slightly larger, handy-sized regional ships.
Okay, to give you a sense of scale, listener, 11,000 cubic meters isn't one of those massive skyscraper-sized behemoths you see crossing the Pacific. It's roughly the volume of a couple of large neighborhood grocery stores.
That's a great way to picture it.
These are the regional workhorses. They do the crucial local distribution, pulling into smaller ports that the massive ocean liners literally cannot fit into.
Precisely. And right now, the global fleet of these small LPG ships is rapidly aging out. The data shows that about 1/3 of the entire global small LPG fleet is over 20 years old.
And 20 years is old for a ship.
In maritime shipping, 20 years is approaching mandatory retirement age due to safety regulations and maintenance costs.
But the order book, the list of new ships currently under construction at shipyards worldwide for these new small vessels is practically non-existent. There are virtually zero new small ships being built.
Right, and that creates a massive structural bottleneck.
I don't get this. If a massive chunk of a fleet is about to be sent to the scrapyard and demand is holding steady... Actually, wait, the filings mention China's PDH plants driving demand? Before we get into the shipyards, what exactly is a PDH plant?
So PDH stands for propane dehydrogenation. It is a chemical process. These massive industrial plants take propane gas, which is a major component of LPG, and turn it into propylene.
Propylene? And why do we need propylene?
Propylene is the fundamental base building block for manufacturing plastics. So the rising global demand for plastics translates directly into rising demand for LPG.
Okay, so the demand for the gas is there, and it's growing, which makes this shipyard situation even more baffling to me. You're telling me 1/3 of the small delivery fleet is about to retire, demand is going up, and the shipyards are just refusing to build new ones.
Basically, yeah.
Why on earth wouldn't they capitalize on that?
It really comes down to shipyard economics. Building a ship requires dry dock space and highly skilled labor, both of which are, finite resources globally.
Right.
A shipyard can tie up a dry dock for months, building a small 5,000 cubic meter ship for a relatively minor profit margin. Or they can use that exact same dry dock and that exact same labor force to build a massive medium gas carrier in MGC and charge a massive premium.
Ah, so they secure a much higher profit margin per ton of steel used.
Exactly. Shipyards follow the highest margins.
So they are prioritizing the luxury SUVs and refusing to build the local delivery vans.
That is an excellent way to conceptualize it, yeah. The filings show the contract clearly. For the larger MGCs, there is a massive bloated order book. The number of new MGCs currently being built is equal to roughly 40% of the existing MGC fleet.
40%. That is a tidal wave of new medium ships about to hit the water all at once.
Which threatens to create a massive oversupply in the medium-sized market.
Right, because when you have too many ships fighting for the same cargo, the charter rates those ships can charge just collapse.
Exactly.
Hmm.
But by concentrating their fully owned debt-free fleet heavily in the small and handy-sized segments, StealthGas completely isolates itself from that medium ship oversupply.
Let's connect the dots here because the market positioning is genuinely brilliant. They've paid off all their debt, so they aren't bleeding cash to the banks.
Right.
They structure their contracts on fixed-time charters, so they guarantee their revenue even if the market goes crazy.
Yep.
They diversify geographically to mitigate the risk of their ships getting trapped in war zones. They operate vessels built in Japan and Korea, avoiding the heaviest blows of the U.S.-China trade tariffs.
That's right.
And most importantly, they specialize in a specific size of ship that the rest of the world completely forgot to build replacements for.
It is a highly disciplined strategy that basically exploits the inefficiencies of the broader market. When the physical supply of small ships shrinks due to age, and demand for plastics and heating gas remains steady or grows, the mathematical outcome is clear.
The rates are going to go up.
Exactly. The companies holding the remaining functional small ships will be able to command significant premiums for their services.
Which brings us back to you, listening to this right now. Why should you care about the shipyard order book of small LPG carriers or the debt-free balance sheet of a Greek shipping company? Because this industry is the invisible backbone of the modern world.
It really is.
When a company manages to pay off its debt while dodging missiles in the Red Sea and navigating Byzantine port tariffs, it isn't just an abstract corporate success story on a spreadsheet.
No, because the friction costs of these global supply chains dictate the reality of local economies.
Exactly. It dictates the cost of the fuel keeping your house warm in the dead of winter. It determines the price of the plastic casing on the smartphone you might be holding. If that invisible, pressurized pipe system of global freight stops or gets too expensive to run, you feel it in your wallet immediately.
And that leads to an unresolved tension in this entire system. We are watching globalization begin to fragment into localized, heavily tariffed regional trade blocs.
I want to leave you with a final thought to mull over, building off exactly what we just uncovered in that fleet math. We know the global fleet of small regional gas carriers is aging out and heading for the scrapyard. We know the shipyards aren't building replacements because they're obsessed with the profit margins of massive ocean-crossing medium and large carriers. But you cannot dock a massive ocean liner in a small regional port. The water simply isn't deep enough, and the infrastructure isn't there.
It just doesn't fit.
So, as this fragmentation continues, who will be left to handle the crucial last mile of global energy distribution? Could the world soon face a localized energy bottleneck? Not because we like the gas and not because we lack the massive ships to cross the oceans, but purely because we forgot to build the smaller delivery trucks of the sea.
It exposes a profound vulnerability. We spend so much time focusing on the grand geopolitical shifts, the trade wars, and the conflict zones. But sometimes the greatest disruption comes simply because the right physical tool for the job no longer exists.
Keep questioning those invisible systems that power your world. The conveyor belt is always running, but the mechanics keeping it moving are vastly more fragile and fascinating than we ever realize. Until next time.